Have you ever bought a stock, held it for years, and still underperformed? The truth is, even great businesses can lead to poor results if you overpay, or if you don't understand what really drives long-term returns. That's what today is all about. Because when it comes to long-term investing, two numbers matter most: valuation and expected return. This episode is part of the Quality Portfolio series, where I'm building a portfolio step by step, from the ground up. And today's step: how to figure out what a stock is worth and what it could return over time. Let's dive in. And let's start with the valuation. I use a model built on free cash flow per share. Why? Because free cash flow is the clearest signal of business health. It's the cash left over after expenses, the cash that could actually be returned to shareholders. When we look at it on a per share basis, it's adjusted for share buybacks or dilution, so we're getting a clean, reliable signal. Here's how the model works. First, I pull 12 years of data, free cash flow per share, and daily closing prices. Then, I calculate the daily free cash flow yield. That's just free cash flow per share divided by price. I smooth out the noise by taking a rolling 5-year average of that yield. And finally, I use that average to calculate a fair value for the stock today. So in plain English, what has the market typically paid for this company's cash flow? And where does the stock trade now? It's like a backward-looking discounted cash flow model. But instead of guessing the future, I'm relying on real data from the past. Quick pause here. If you're finding this helpful, and you want to access the full write-ups, the models, and visuals I use, be sure to sign up for the newsletter, Quality at a Fair Price. That's where I break everything down in detail, and share the latest updates first. You'll find the link in the description below. Alright, back to the framework. Every valuation model makes assumptions, mine included, but I try to keep it simple. My core assumption is this: that the market tends to value a company's free cash flow consistently over time. By looking at what investors have actually paid in the past, I get a grounded sense of whether a stock is attractive today. It's not about precision, it's about perspective. And to complete the picture, we also need to understand where the company is headed. That's where the return estimate comes in. Here's the formula I use to estimate a stock's return over the next several years. The return equals the dividend yield plus a return to fair value factor plus earnings growth. Let me walk through each one. First, we have the dividend yield, the income you're getting right now. Then the return to fair value factor. If a stock is undervalued, this estimates the upside if it reverts back to fair value over 5 years. And earnings growth, the 5-year growth forecast based on Wall Street analyst estimates. Now, you might ask, wait, why are you using earnings growth if the valuation model is based on free cash flow? And that's a fair question. While I prefer free cash flow as a long-term metric, analysts focus on earnings. That means earnings forecasts are more widely followed, better vetted, and more consistent. So rather than create my own forecasts, I use the consensus as a proxy for growth. It's not perfect, but it's practical. Let's put it all together with a real example by looking at ADP, Automatic Data Processing. ADP's free cash flow per share has grown steadily for over a decade. Exactly what I want to see from a high-quality compounder. When I chart the free cash flow yield and the rolling average, the trend is clear. Investors have valued ADP's cash flow very consistently. And today, the stock appears to be trading about 9% below its fair value, based on the model. So what kind of return are we looking at? The dividend yield is 2.03%. The return to fair value factor 1.74%, and the earnings growth forecast 9.02%. Add it all up, and we get a total estimated return of 12.79%. That's a compelling setup for a stable, well-run business. So what does all of this tell us? ADP is a high-quality company with strong, steady cash flow. Its price tracks closely with the model's implied fair value. And right now, it looks modestly undervalued, offering a solid return outlook. But ADP is just one of 80 companies in my investable universe. This framework lets me rank all of them, by quality, by valuation, and by forward return. And that's what makes it possible to build a high-conviction, long-term portfolio. Now that the valuation work is done, the next step is simple: constructing the portfolio. That breakdown, how positions are selected, sized, and balanced, will be released in the newsletter first. So if you want to be the first to see it, be sure you're signed up. If you found this helpful, make sure to subscribe so you don't miss what's next. And again, if you haven't already, check out the newsletter. It's the best way to stay in the loop and follow the full journey as the quality portfolio comes to life. Thank you for joining me today, and see you next time.